get your pen, your paper, and your thinking caps on, because tonight's conversation is going to be a lot more intimate, a lot more in depth. We're going to talk about this from a strategy point of view, how you can leverage opportunity zones in order to grow your wealth, even if today you have no capital gains. So, Venroy, actually, I want to start the recording here again. So, I went back and looked for our original conversation that we had, which was in January. So it's officially been 6 months since you've been with us. So first of all, that original conversation was wonderful. It was a great topic, and we decided to kind of come back together and really put some strategy behind some of the things that you had talked about. But before we do that, why don't you introduce yourself to the community and tell us a little bit about who you are.
Hey, so thanks for having me again. So as mentioned, my name is Venroy. I am a partner at a law firm of Dickinson Wright, which is a law firm based out of Detroit with offices throughout the Mid-Atlantic and Midwest and in the West. So I'm a corporate attorney partner there. So I do mergers and acquisitions. So businesses buying other businesses or investments. So, whether it's venture capital or private equity fund type investments. And so honestly kind of came to the, opportunity zones kind of just as a result of kind of reading, different publications about, M&A activity, our new legislation. And quite frankly, it's led me into digging deeper into opportunity zones, particularly as it relates to real estate, because that's quite frankly where we're seeing a lot of the investments, being geared. And so over the course, I've been, following the legislation. I've, written articles, particularly about how, how we can utilize the legislation to benefit our communities, particularly because I think 54% of all opportunity zones are in predominantly Black and Brown communities. And so you start thinking about the fact that there's huge tax incentive for investment in our communities. And quite frankly, the letter of the law makes it, creates somewhat of it's interesting because it creates a barrier, but it's actually like something that's it's a barrier that can be overcome. And just kind of thinking through, strategy around how you actually get to benefit from the law. And so I've written articles that have been published in numerous publications, including one in Black Enterprise, specifically about how Black people can use the law to benefit their communities. And so, they kind of trying to spread the gospel. So this is just another spreading of the gospel.
The spreading gospel, and you are in the right place. I also want to let people know that this evening, because we have an intimate group, if you want to come on, we'll put you on audio only, and you are able to ask Venroy your questions by audio as well. So, so let us then talk for just a second about the opportunity zones. We know we heard the buzzwords a few years ago now. It was done under the Trump administration. It was launched by, I'm sure somebody besides Tim Scott actually started it, but he was like one of the main people that was out in front.
Tim Scott and Cory Booker.
And Cory Booker. Okay, so it was bipartisan. And PI was involved, and a whole bunch of people at the White House and the Congress and things like that. But one of the big things that came up with opportunity zones is, okay, is this going to be something that gentrifies us out of our communities? Is this going to be something where we are not able to participate in the economics of it? And I would love for you to just chat, for a few seconds about those issues and concerns that people have.
So look, I think those are very real concerns. Like the reality, which for those that don't know, ultimately what the reality is that this legislation, as much as they might try to, market it as being something that is for, for the benefit of, these underinvested communities, the reality is that the real beneficiaries of the project are wealthy people, right? Yeah, I mean, that's just the facts. Like, the biggest beneficiaries of the legislation are going to be people who have capital gains in significant enough numbers that they can invest and not care about getting a return on their investment for 10 years, right? Now, who are those people? What do those people look like? So despite the fact that 54% of them are in minority, Black and brown communities, my biggest fear and concern is that what you're ultimately going to end up seeing, if we don't try to really kind of explicitly push ways that we can get involved. And I've worked on different legislation about how we can actually get Black and brown participation in the opportunity zones at the state level here in Maryland, where I am. I actually talked to the guy. The Economic Innovation Group was a group that actually put together the opportunity zone legislation. And, this idea has actually been around for quite some time. They apparently also had pushed it to President Obama, and they didn't move on it, but it was something that came, I think the guys from, I think it was either Facebook or one of those big tech companies were the ones that first started pushing this idea. And the reality is that, I wrote in my article that I wrote for Black Enterprise that this is a law that really is designed for Donald Trump and his friends and his rich friends, right? If you are able, you think about what development looks like particularly on a real estate standpoint, right? Like, you put your money into neighborhoods that have not been invested in for years, and you ultimately hope that over the course of time that the values increase and you're able to exit that tax-free. Like, that's what the opportunity zone law does. And if you think about other communities where we have seen gentrification, that's actually pretty consistent with the timeline, right? It takes about a decade for you to really see a neighborhood really kind of change. And so I think it's a very real concern that it will absolutely lead to gentrification without a question, because if we don't make the steps that Black and brown people get to participate in it, and we do it in the ways that we've seen real estate development happen over time. I mean, just think about it, right? Like, we're talking about when this first came out, all people started raising all these funds, hundreds of millions of dollar funds. And there's a timeline by which you have to deploy the capital, right? And so what you're seeing is that a lot of people who are raising the funds, they are trying to do big projects where they can deploy the capital quickly, right? What does, for a neighborhood that's been underinvested in, that's a low income census tract, what does that look like if you drop $100 million project in the middle of it, right? Like, it's going to lead to gentrification, no matter how you cut it, unless you allow for other participants in the market or people who are willing to think about this in non-traditional ways. It absolutely will, because in my view, I just don't see how you drop a significant project in these communities that have been underinvested that doesn't lead to gentrification, right? Because it's going to cause property taxes or whatever to go up, and then there's going to be other things that are going to just impact the way that those communities operate. And so my fear has been that, but I am optimistic that with people being thoughtful. So I've gone and seen how other states are thinking about opportunity zones. I actually went to Ohio recently, and they actually implemented a law at Ohio that I was trying to push in Maryland 2 to 3 years ago, that would essentially allow for Black and brown people to participate in the opportunity zone legislation. And this is not a part of legislation, but I just want to level set as to why I talk about this from a Black and brown context, right? So the requirement for you to get the tax benefit of the opportunity zone is that you have capital gains, right? Like, it can't just be you get paid and you get, you have $10,000 of income that you have, this disposable income that you want to invest, and you invest in the opportunity zone. That's not sufficient, right? That money is ordinary income. And if you invest in the opportunity zones, you're paying the same tax that you otherwise would pay and you're not getting any tax benefit on the end of it, right? I mean, you're not getting the opt zone tax benefit on the end of it. You only get the benefit if you have capital gains. Now, let's just think about the situation of Blacks in America, right? So we know that the vast majority of Black wealth is in their primary residence, right? Mm-hmm. First thing. Well, guess what? In your primary residence, the first $250,000 of appreciation is not capital gains, right? So even if you were smart and you bought a property that's your primary residence and it appreciated for $200,000, and for whatever, and I'm not advocating that you sell your primary residence, but you, in order to participate in this program, but you did sell it, that $200,000 is not even capital gains, so you can't even get the benefit of the program anyway, right? Mm-hmm. So there is that reality. So okay, so then we also know that we tend to participate in the, how do people traditionally generate capital gains? It's real estate investment, not their primary residence, and they're not doing it as like a buy and flip investor, because that actually doesn't generate capital gains. That also generates ordinary income. So you have to be like a buy and hold type investor, and then just happen to be like doing some liquidation, right?
Right.
Or you have and the other ways that heavily invested in the stock market, right? And you know that because of the stock market and what's been going on over the last year, a ton of capital gains have been generated over the last year. That's great. But the reality is that we know that maybe prior to this year, but certainly historically, Black and brown people participate in the stock market at much lower rates than white people did, right? And there's just a whole issue of generational wealth, like the ability to just have capital, like assets that have appreciated over years, and then be able to sell that and be able to get this capital gains is something that, quite frankly, Black people in this country haven't been able to really have, kind of like that generational time period of like acquiring assets to be able to generate capital gains. And so with that as a fundamental basis of getting to take advantage of the law, like, we are at a disadvantage, right? And so that's just
so then let's talk about the brand promise of tonight's conversation, which is, what can we do? So then let's take it step by step. So if somebody wants to today start investing in the stock market, they can. And you mentioned in our first conversation that they would have between now and 2026 to get the capital gains. Correct. So talk to us a little bit more about that. And we had a gentleman come on a few weeks ago to talk about options trading. We had another woman, Dr. Kelly, come on. We had Diamond Dave, for those of you who are part of the 10K community. We had Diamond Dave come on to talk about options. We had Dr. Kelly DeClue talk about options as well. So I'm also curious, Venroy, if somebody is able to leverage options and some of these other ways of getting capital gains, does that count between now and 2026?
Yeah, so one of the reasons why I like the legislation a lot is that it's actually like super flexible. Outside of the capital gains requirement, which is a decently high obstacle, like, you actually can get in because the law is flexible. It says that it doesn't have to be long-term capital gains. If you have short-term capital gains or long-term capital gains, so long as it's capital gains, you are able to utilize it to invest in opportunity zones. Now, right? So from my standpoint, like, the reason why I think there's potential is that the law also says that you actually, the opportunity zones have been designated until 2026. And so long as you actually get your capital gains invested in the opportunity zone, in the op zone business, or opportunity zone, in the op zone fund, and then invest in opportunity zone business by 2026, you are able to actually participate in the benefits of the law, right? And really what we're talking about. So I'm trying to like balance like telling you how the law works and then telling you like the practical part of it, right? So the law basically has two benefits, right? Or really three benefits, but so the first benefit is that let's say if I had stock in Google and I sell it and I get a $10,000 gain, right? And I put that in an opportunity zone fund, right? First off, that $10,000 gain that I get, I don't have to pay taxes on it this year. I don't have to pay taxes on it until 2026 if I keep that money invested, right? So there's that first benefit. I get to defer the payment of my capital gains on that capital gain, that on taxes on the capital gains that I generated to invest in the Opportunity Zone Fund, right? And the second part is that initially when the law came out, it was that if you held it for 5 years, you got a 10% decrease in your taxes. And if you held it for 7 years, you got a 15% decrease in your taxes. Because of the fact that it's 2021 and that the timeline is now 2026, essentially all we're talking about for this second benefit is a potential that by holding it for 5 years, meaning from now to 2026, you can get a 10% decrease on the taxes that you would have had to pay on that money, right? So that's the second benefit. Those two benefits, in my view, are much more geared to the people who are wealthy, who have capital gains right now that are in 2019 that they could have invested. The much more significant benefits of the law is that if you are invested capital gains in an opportunity zone and you hold that investment for 10 years, or you invest in an opportunity zone for a decade, any gain, any appreciation in the value of your investment, once you liquidate, you pay no taxes on. So put my money in 2026 or 2025, hold it till 2035. Whatever the value is, when I sell it, I don't pay any taxes on the increase in the gain that I get, right? So that to me is where we're really playing, right? Because look, you can try and liquidate assets for the purposes of getting like, you know, a 10% decrease in your taxes. That's cool. But really, we're talking about like, if I'm able to invest in something and allow it to grow over the course of a 10-year time period and not pay taxes on that, that's the piece that's really important, right? And so from a practical perspective, that's where we're coming from. And so when we start talking about like, you know, whether it's real estate that I'm buying and holding and then having a liquidation event, or I'm investing in the stock market, or I'm buying options, or I'm buying all these different avenues through which you are able to generate capital gains, because the law says very clearly, it doesn't care if it's short-term or long-term capital gains, right? So long as it's treated as capital gains. And look, you have to talk to your tax accountant to just confirm that.
The CYA, yes. Talk to your attorney and your accountant.
You have to talk to your tax person, because quite frankly, you know, if you are a trader, I'm not sure if that counts as if you will ultimately, if it will be treated as capital gains or ordinary income. Because if that's what you do, if all you do is trade income and you have a certain amount of volume and you're doing it on a certain frequency and that is your profession and that's how you designate it, I'm not sure if that counts as capital gains. So you just need to talk to your tax professional about that depending on your circumstance. But if you invest in stock and you get a gain, or you invest in options and you get a gain, or you have a real property that you decide to sell and that's an investment property and you get capital gains, you now have capital gains regardless of how long you held it for, as it relates to the stock and the options or the other assets, because it's not just those, it's other assets as well. If you have that and then you put that in an opportunity zone, you then have the potential. And again, because the timeline is until 2026, you can essentially do that until 2026. You can buy assets and allow them to generate gains until that time, sell, take those, harvest those capital gains and put those in an opportunity zone fund. And now you're able to participate in that much more significant upside appreciation of not having to pay taxes, if, you know, assuming the appreciation of the value of that money over the course of a 10-year time period.
So did everybody get that? Put a 1 in the chat if you got that. So there are multiple ways between now and 2025 for you to get the money, 2026, sorry, for you to get the money to invest in an opportunity fund. You can, you know, do it through the stock market. You can buy and hold through the stock market. You can do options trading. You can do all sorts of trading. Again, check with your accountant just to make sure that you're not like a trader, you know, you have some other accounting issues, right? And then check with a lawyer who understands opportunity zones as well, just to make sure your situation. Good. I'm seeing the ones coming through. Perfect. So, so there are ways that you can have a full-time job and still do something part-time to get your money up so that you're able to put it into this tax-free vehicle from 2026 to 2036. Let's just say 10 years, right?
And so, and
The other
actually,
thing is
I just want to
crypto.
put a pin on that because you don't actually have to take it out in 2036 either. You actually, so long as you liquidate it prior to 2047, to the end of 2047, then
Mhm.
you are able to, so, and if you put that money away and you keep it until the end of 2040, right until 2047, and you liquidate, any appreciation that you get on that is tax free. And so that is important because it's not like, oh, because and the reason why that's important is that, like, let's say you put it in 2026 and the market crashes in 2036, you
Mhm.
don't
You
want to
don't
have
want
to
to
be
sell.
forced to sell your asset
Yeah.
at that point. You can continue to hold it until the market and the capital and the gain that you have gotten over the course of time is significant enough that you're going to take it out and take that tax free.
Yeah. So that's an important point as well. So, what about crypto gains? Some people were fortunate enough to get into crypto early.
Yeah, I don't even so crypto gains to me is like any other, is it's the SEC has basically said that it's a security, and
Mhm.
so I don't know why that would be any different than
Any
any other.
different? Yeah. I was thinking that that would be a capital gain
Yeah,
because,
I
yeah,
think it would
yeah.
be the same. I think it would be treated the same if you
Mhm.
have big capital gains off of crypto.
Yeah.
then absolutely. In fact, I've actually been saying, I'm like, all these people that have been getting all this money off of crypto and off of these like stocks that are shooting up, like AMC or or GameStop or whatever, like
Mhm.
really, like they need to recognize that if they sell, they're gonna have a significant tax burden this year potentially. Opportunity zones is certainly a way that they could potentially, like, at least defer the payment of their taxes until a later date and be able to use that money to potentially invest for the long term.
Invest some more. So Joe Biden has been talking actually about increasing the capital gains rate. Now, I don't think he's going to do it. I think he has too many rich donors, but he's been talking about this. So if it does happen and the capital gains rate does increase, the capital gains tax rate does increase, I just thought about this. I think that the opportunity zone funds, like people are going to be rushing to put their money in because he's talking about, I think, more than doubling it, right? Um, so what I'm trying to say is there's going to be a lot more competition for this. So then let's have another conversation. All right. So one of the things you said is the people that started out are Donald Trump's rich friends, right? And they are looking for huge real estate projects to get into, which means, in my opinion, that the smaller real estate projects, the smaller real estate development projects, whether they are commercial or residential, can be for us. I'd love to hear your thoughts about that. What do you think with regards to that?
So I actually think that's exactly right. Like, I think there's a ton of potential of like being able to basically piggyback off of investments that are already happening, or being able to use this as a means to basically revitalize your neighborhoods while also getting a tax benefit, right? Because
Mhm.
the reality is that all you have to do is to be able to be using, and look, there are different rules around, like particularly if you're investing in real estate, right? So the
Mhm.
law requires that it's either original use or you have to substantially improve the property. Property is not going to ever be an original use. It's written in the register, in the regulations. So essentially, what you have to do is to substantially improve the property. And I'm going to actually go back to the original use point in a second because I actually think it's very important. There's a nuance in the law that I think is important. So what does substantial improvement means? Substantial improvement means that you have to put as much into the renovation as you bought it for, not including the value of the land, right? So if you buy a property for $100,000 and the land is worth $20,000, you only have to put $80,000 into the renovation, and that's a substantial improvement. Um, but you can do that for rental properties. You can do that for so long as it's being used for commercial purposes, that's fine. And so
It
certainly,
just
unlike
cannot be your primary residence, is
be a
basically
primary
what you're saying.
residence, it can be a house that you're using for yourself, or it has to be something that it's a commercial use.
But
And
it can be something that you get in rent to your cousin who is paying rent, right?
yes, commercial use.
Okay.
Um, so that's fine.
Shout out to the family bank. Sorry.
Yeah,
Um,
so that you get commercial. I mean, you do that. And so it's just a point to that, like you can do that for whether it's individuals properties or like smaller developments, right? So, and certainly you can piggyback off of developments that are happening. If there are other bigger developments happening, you can obviously piggyback off of the appreciation that's going to be driven from those investments being happening in those neighborhoods. And quite frankly, you know, if I'm looking at a neighborhood and seeing that there are other things that are coming or close, and I'm going to take a bet that in 10 years this is going to be something, then it's obviously it will make me potentially more willing to invest in some of these neighborhoods that by definition, at least theoretically, have been underinvested in. The other part I wanted to get back to the original use piece is that the legislation is a part of the regulations did clarify that if a property is bought from like out of like tax sale or from the government, like this, like like if the city like had like if the city had like taken back property and then you bought it from them, you actually don't have to substantially improve the property based. It qualifies as an original use. Like you actually don't have to substantially improve it. And if a building has been vacant for 3 years, you don't have to substantially improve it either. Right now, look, there are all kinds of like business reasons why you have to be thoughtful about like neighborhoods that you're buying in and whether or not this makes sense. And if there's some neighborhoods that 10 years from now are going to look exactly how they do right now. So that's just the reality. So you have to be smart. Like everybody has to make it like this tax benefit should not be the reason why you are using investing opportunity zone. The deal should make sense otherwise. But certainly there are opportunities where like in Baltimore, and I've been thinking about this, like the city, they do tax sales. Like if there are tax sales and I can buy the property and renovate it, but not have to renovate it up to the level, to the like substantial improvement in terms of my immediate cash flow, then that might be something. It might make sense under certain circumstances that you're creating a product that's beneficial for the community and that is going to, over the course of a 10-year time period, substantially like appreciate. So there's that.
Perfect. So Amy is asking a clarifying question. Is there a cap on the capital gain to invest in an opportunity zone fund, or can it be any amount?
It can be any amount. So we have literally seen like hundreds of millions of dollars of cap. We've seen billions of dollars being invested in opportunity zones already, right? Like funds that have raised billions of capital, and people who are wealthy are putting as much money as they want.
I think she's probably thinking, can she
no
get capital gains of $10,000 and put it
no limit on
into
how low
or how
little you put in. But I mean, again, it's just the economics, right? Is it worth it? Does it make sense for you? Like, are you going to take out money and put $1,000 in? What's $1,000 investment going to be worth over 10 years? Like, there has to be other, again, there's business, it has to make business sense. But certainly one of the things that I've done actually is that I had a group of friends who had, $8 to $15,000, $20,000 of capital gains. We all sold our assets and generated some capital gains, and then we formed a fund, and we formed an opportunity zone fund, which is actually really simple. Opportunity zone funds just have to be a corporation or a partnership, and an LLC taxed as a partnership counts, right? So we just formed a fund, and it has to be that you're using 90% of your investments are going to be in an opportunity zone business, right? And so if you meet that criteria, you have that in your operating agreement and your documentation, you are an opportunity zone fund, and then you have to do the actual investment and meet the criteria, because there are all kinds of, like, at 6 months and at a year, you have to have their like measurements in terms of like the fact that you're in 90% of your investments actually have to be in the opportunity zone.
Right.
Right.
So put a two in the chat, everybody, if you understood that number one, anybody with capital gains, no matter how little you have or how much you have, can start an opportunity zone fund. And number two, you can start it by yourself. You can start it with a couple of friends. You can start it with the family bank, or you can get some multi-billion-dollar fund if you've got the money. Go ahead,
When you
Venroy.
say a family bank, you just mean the, what do you mean?
Well, so our family banks are when families come together in order to invest. So that you would obviously for this type of family bank, you would need a separate operating agreement and a separating LLC and things like that. You want to set up your structure legally, but it can be your family members coming together saying, we're going to put our capital gains in here and start our own, Cherie family opportunity zone fund, right?
Correct.
So another thing that you mentioned in our original conversation is that we are able to, let's say, for example, for real estate, we see a house that is $100,000, and let's say we need $200,000 to get it up to code. We can go to the bank with our 20%. And the bank would actually potentially loan us the other 80%. Obviously, that would depend on the bank, your credit, things like that. Can you reiterate that for the family as well? Because now we start talking about how to leverage these funds.
So the funds do not have to be the only funds that are in the deal. They're just a part of the capital stack, and whatever that is worth after the course of the 10 years, that's what you don't pay taxes on. So if you are looking at whether it's it's how in the building, right? It's a building and you have capital gains of 20%, right? Quite frankly, if you have capital gains of 10% of the price of the house, right? And then the bank needs you to put 20% up, and you have regular income of the other 10%, right? You can put that money in and get the bank to layer on the 80% financing, right? And the 10% that's capital gains, so long as it's done through an opportunity zone fund, and it's an equity investor in that property, right? That in the course of 10 years, whatever that 10% is now worth in 10 years, that's tax free. And so you can layer on all different types of capital into the stack. It's just that the money that's an opportunity, that's capital gains, is the only money that's going to get the opportunities on tax benefit. But you can get debt, you can have other equity. It's just that they're treated differently from a tax perspective when you actually ultimately sell the property or refinance the property or whatever.
Right. I mean, what I loved about this when we had our original conversation is there are various ways that you can do this. You can have some of the money that's your capital gains money, and then some of the money that's just your regular tax income money put into the same deal. Obviously, the accounting needs to be very specific, but you can do that. Or you could have a friend who has regular, income money, and you have capital gains money, and you can still do this deal. There are a ton of ways, and that was the whole point of today's conversation, was for us to really start expanding our minds with regards to how can we participate in this. And the final thing, and this is one of my favorite things, is we can also invest in businesses using opportunity zone fund money. And for me, investing is not just starting and growing businesses, but also buying businesses as well. I was working on a business plan for this gentleman who's buying a commercial property in an opportunity zone, and he needed me to write the business plan because he was going to pitch it to some people. And they're going to, build it out into an event center / lounge type of place. So people are already starting to think about, from a business point of view, how can I start tapping into some of these funds? And then from an investor point of view, you can think about that as well. So again, just kind of getting people to stretch and stretch their minds, because sometimes investing in a business has a multiple factor higher of return than sometimes investing in real estate, or maybe you want to do both. So I'm going to open that up to you then, Roy, to talk about the, either getting money for businesses or investing in businesses.
So it's interesting, right? So the opportunity zone investor world is interesting because there's an interesting dynamic. You're absolutely right. Like like I've spoken on panels with other panels that talked about the fact that like the potential of like opportunity zone investment in a business, the return is potentially significantly higher than it is in a real estate deal, right? Because like if you invest in the right type business, like certainly venture capital investors, they're looking for like a 15x return on their money, 10x, 15x% return on their money, right? So imagine being able to put money into a business and getting a 10x return on that money and not having to pay taxes on that money. Now, look, there's all kind of discussion around whether the 10-year time period for an investment in a business is too long, and whether or not like you're going to have a liquidation event before that. But depending on the type of company and what you're trying to do, like that is not something that's out of the like that's like not every company is going to be like a venture type business, right? There are going to be businesses that are going to give you back over the course of a 10-year time period, the value in the property might be worth, the value of that business might be worth four times what you put into it. And you can take that tax free. And that actually has other positive externalities because potentially you're creating jobs in those communities. So there are benefits, there's income that's coming in that's that you can get, and that's you'd have to pay tax on that. But there's money that's cash flowing potentially from the business, right? And so there's a ton of potential, and quite frankly, the double whammy is that if you buy a building and move a business into that building that's in an opportunity zone, and now invest in that business, then that money that you invest in the business and the money that you invest in the real estate are now eligible for this benefit. And it's synergistic, right? Because now that you have a business that's potentially thriving in this property, that probably helps the value of the property. And, they kind of just play off each other. And so, again, whether or not you're going to be investing in the business for 10 years, it depends on the type of business, but there's certainly a potential significantly more upside for investment in businesses than if you invest in buildings. But the reality is that the reason why we've seen a lot of people who are investing in opportunities or investing in businesses is because it's just easy, right? Because there are requirements about like your money has to be invested in 90% of your investment for the opportunity zone fund has to be in an opportunity zone, whether business or property. Like we know, and it has to be there, right? So we know a building ain't moving. Like it's gonna be there. And so if you invest there and it's an opportunity zone, it's gonna meet the requirement, right? As opposed to like a business could potentially bounce around, but there is a ton of flexibility. There's some safe harbors that they brought about as a part of the regulations for that would allow you to invest in businesses, and so long as the salary of the people who are helping to generate 50% of the income are in an opportunity zone, or the hours worked, 50% of them are in the opportunity zone. And then if you just look at it overall, is 50% of the revenue being generated from the opportunity zone, then that's also eligible. Then the investment is also eligible for the optional tax benefit. And so there's just they have provided regulations that make it easier to invest in businesses. You can invest in both op zone businesses and property. And it's up to you guys to determine what your risk tolerance is, what the potential of this opportunity is, and what the timeline and horizon for that opportunity is. But there's certainly like a ton of upside potential of investing in these businesses.
Yeah, I mean, I can foresee anything from grocery stores to incubators to, you know, retail, office buildings, even industrial buildings. You know, they're going to be as these neighborhoods shift and change. You know, Amazon's going to become more prevalent. People are going to need places to put their trucks and things like that. So, all righty, this is the part where you all can participate. So if you want to ask Venroy a question, you will not be on camera. You will just be audio only. So you don't have to worry about getting cute or anything like that. But I did want to open it up just for a few questions. If you have a question for Venroy about how you can actually take advantage of this opportunity. Because this is a huge opportunity, and these opportunities really only come a couple of times in our investing life cycles. So we want to be able to take advantage. So either raise your hand or put in the chat that you want me to call on you. All right, Robin, you're my first person up. Give me a second. And you should be able to talk, Robin.
Hi, how are you guys doing?
Good. How are you doing?
I am wonderful. I have a question about the areas that these opportunity zones are in. I'm in Southern California. However, we are adding some, I want to say, a presence for our business in other areas. We actually buy businesses also. So when you said that, Cherie, about buying businesses, and we actually have we kind of have a formula for that on how that is done. And so is there a list? How do you find out, Venroy, if I'm saying your name correctly, how do you find out where these opportunity zones are located?
So they are designated and they're set. They've been set since January 17 or 18. But most states, certainly in Maryland, they have, like, you can literally Google it and they'll give you a map and it will show you where the opportunity zones are. And here in Maryland, we actually have a tool where if you put an address in, it actually tells you whether or not it's in an opportunity zone or not. And so you can Google and find a map. I will also say that because you're in California, California is kind of tricky because I think they actually decouple from the federal regulations as it relates to opportunity zones. So you're certainly going to want to talk to somebody. If you're talking about doing it in California, you're going to want to talk to a California bar attorney to make sure that what you're doing is compliant with how California is decoupled.
Okay, because I am friends with several of the mayors. We have two African-American female mayors in the area that I'm in. Would they probably know?
Yeah, they should, absolutely. So the governors of each state were the ones that designated the opportunity zone, but mayors have absolutely been trying to at least. I've been on calls with mayors talking about how they can try to use opportunity zones to spur development in their communities. So I would imagine so.
Okay, thank you so much.
Thanks, Robin. Good hearing from you. Okay, does anybody else have a question for Venroy? Any other questions? Going once, going twice. All righty then. Well, Venroy, it was amazing chatting with you. This is, like I said, an incredible opportunity for people to, number one, think about how they can get capital gains, because it's not too late for you to even get in the game of getting capital gains. And then number two, how to disperse them, set up your, overall an overview of the opportunity zone funds that you can set up, and then places that you can invest. So I do think we hit on all of those areas. Is there anything else you could think of that we need to think about, as we proceed?
I mean, look, at the end of the day, right? Like, the great thing about the legislation is that it's because of this flexibility, like, we're working on different models about like how you aggregate capital. Like this is actually allowing us to participate in markets that we otherwise would not have had the opportunity. And so smaller, you can have like, smaller dollars and pool them with others who have other capital gains, and be able to get this benefit. I mean, like, quite frankly, like, I cannot overstate how significant this law is. I mean, if you just think about, and I come from New York, so I lived in New York, I lived in DC, and I've seen changes that have occurred in neighborhoods like Harlem and Brooklyn, and in Washington, DC, like Columbia Heights and H Street corridor. And think about I actually left DC to move to Baltimore a decade ago. And it doesn't feel like that long, but when I left, like, Southwest DC and the harbor and all that over there just wasn't really that much of a thing, right? And I remember what Harlem was a decade ago and what Brooklyn was a decade ago. And you think about the value that's created in some of these communities where we are over the course of a 10-year time period. And it's not unheard of that you could have invested $100,000 in a property in Brooklyn, and that's now worth $1 million, right? Like, that's not unheard of. And so think about the ability to take $900,000 tax-free, right? Like, look, I'm not going to act like that's the norm, but we've seen this happen over and over and over and over and over again in our communities. And this is a benefit that, like, maybe it wouldn't make that much sense if, like, maybe too much risk if, like, all you're doing is like, yeah, hopefully I get some tax, I get some appreciation, and you also get like the cash flow off the properties. But now you're able to take that money tax-free. Like, to me, like, that's just such a significant potential upside that it's something that we, it might not be for everybody because the time horizon might be too long, but it's certainly something that we should be thinking about in terms of how we actually create wealth in our communities. Because whether it's investing in the businesses or investing in real estate, it can actually have some real impact.
Absolutely. And, it's past time for us to really get in the game, really get strategic about this. I encourage people, if you are thinking about starting an Opportunity Zone fund and you want to talk with us at the 10K Project about your process of doing it, it can inspire others. So you can reach out to me, info@the10kproject.com, and we'll talk about having you featured on one of our Building Black Wealth sessions. And then the final thing is, I did put Venroy's LinkedIn into the chat here. So definitely take it, become a first connect of his. And Venroy, if people want to, do you do a blog or anything like that, or any kind of social media that we should follow?
Not really.
Not on this. Well, look, if somebody wants to help Venroy get that started, then I'm sure that maybe he'd entertain it. I know he's super busy in his law practice. So thank you so much for being here today with us. And I hope that everyone got something out of tonight with regards to strategy, real strategy that you can put together to take advantage of this legislation. So thanks, everybody. See you at 8 o'clock tonight. Bye-bye.